Bitcoin markets are once again flashing warning signs, and this time the fear level is reaching heights not seen since one of the most traumatic chapters in crypto history. Over the past several days, Bitcoin's volatility index, often referred to by traders as a panic gauge, surged to its highest reading since the collapse of the FTX exchange in late 2022. At the same time, Bitcoin prices dropped sharply, sliding toward the $60,000 level, a move that sent shockwaves through the digital asset market. In a matter of hours, Bitcoin lost more than 10% of its value. Billions of dollars were wiped off the market as selling pressure intensified. Much of that decline was fueled by liquidations, forced sell-offs of leveraged positions, as traders who had borrowed money to bet on higher prices were pushed out of their trades. As prices fell, liquidation engines kicked in automatically, accelerating the drop and driving volatility even higher. This feedback loop, falling prices triggering forced selling, which then pushes prices even lower, is a familiar pattern in crypto markets during periods of stress. For many investors, the moment felt eerily similar to late 2022, when the sudden collapse of FTX exposed deep structural weaknesses in the industry and shattered confidence across the ecosystem. While today's crypto market is arguably stronger, more regulated, and more transparent than it was then, the emotional response feels strikingly familiar: fear, uncertainty, and a rush to reduce exposure. Importantly, this sell-off did not occur in a vacuum. Broader financial markets have also been under pressure. Global investors have been pulling back from risk assets amid concerns about economic growth, tighter financial conditions, and persistent uncertainty around inflation and interest rates. Technology stocks weakened, bond yields moved higher, and speculative assets, including cryptocurrencies, felt the impact immediately. Bitcoin, often viewed as both a speculative investment and a macro hedge, found itself caught in the middle. As risk appetite faded, traders moved quickly to protect capital, pushing Bitcoin down toward levels many consider psychologically critical. The $60,000 range is more than just a round number. It represents a key support zone that traders and analysts have been watching closely. A decisive break below it could trigger further selling, while a strong defense could signal stabilization or even a potential reversal. Since touching those lows, Bitcoin has shown signs of attempting to stabilize. Prices have bounced modestly, but volatility remains elevated. That tells us one important thing: uncertainty is still very much in control. Some analysts argue that extreme fear can mark turning points in markets. When panic reaches a peak, it can mean that the majority of sellers have already acted, setting the stage for a recovery. Others caution that high volatility often leads to false rallies, short-term bounces that ultimately fade as broader market pressures reassert themselves. At this stage, no clear consensus has emerged. What is clear, however, is that Bitcoin is once again reminding investors of its defining characteristic. It moves in cycles, fast, emotional, and often unforgiving to those who underestimate risk. Whether this episode becomes a temporary shakeout within a longer uptrend or the beginning of a deeper correction will depend on how markets digest the current wave of fear. For now, the crypto market is in a holding pattern, watching support levels, monitoring macro signals, and waiting for clarity. Until then, volatility remains high, nerves remain tight, and Bitcoin's next move could set the tone for the entire digital asset market in the weeks ahead.